Hey everybody, I hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Monday, September 16th, 2024. It's the start of a new week, so we'll start off on the weekly chart. The market's in a tight trading range. Up for a couple legs, back down, up and up. Lots of overlapping bars. Now we know that 80% of breakout attempts in trading ranges fail. What we have here, we have a rally, a pullback, and a high one buy above last week's high. But ask yourself, if you're buying that high one, stop below the signal bar, what's the probability the market gets here before here? In order to take a trade with one-to-one risk reward, you have to be at least 60% certain. And this is not 60% certain of anything. It rallies and then we sell off. It sells off and then we rally. And it's back and forth, big up, big down. So I think at best, there's a 50% chance we go here before here. But the reality is, if you think about what's happening here, what do the bears want? The bears, bull channel, trendline break, retest of the highs, and then we found sellers. But then 50% pullback of this rally, we found buyers. But when we come back to this high, the problem is there's sellers here. So think about it. If you're a bull and you see a tight bull channel, you buy for any reason, maybe you buy below this bar, then you get trapped. So you scale in lower, the market gives you a chance to exit at break even, and you take it. And if you didn't take it, the market's giving you another chance. The reality is there's probably sellers up here. This is high in a trading range. The other problem is if you're buying, stop below here, buying above, does it make sense to sell here? If you're putting a stop order to get out of longs, then you'd be selling in the middle of a trading range. And this is where traders bought. Here, traders got trapped. And when we retested this price, we rallied. So there's buyers here, support. In reality, the market is getting squeezed. The bulls, higher highs, higher lows. But now we have a lower high. And you can see the market's getting squeezed into a tighter and tighter range. The market's in breakout mode. And probably sellers above, buyers below. The daily chart coming into the day, we have 5 consecutive bull bars, but after 4 consecutive bear bars. So big down, big up. We're testing an area of resistance. Tight trading range, but we got a bear breakout. So traders up here got trapped. Bulls who were long trapped into a bad long, a losing long position. Bears who did not sell and didn't catch this move down are also trapped out of a winning trade. You could argue leg 1, pullback. This was the second leg down for the bears, but in either case, this is probably resistance. And even if we do go a little higher, then we're high in a trading range. So probably sellers not far above. And you can see one more thing about the daily chart. Big reversal bar, decent sized body. The next bar, follow through, but smaller body. More follow through, but even smaller body. So the momentum for the bulls is slowing down as we approach resistance. So the market opened with an outside down bar and it got follow through. But the problem You can draw a channel line like this, maybe 1, 2, 3, or from over here, 1, 2, 3. In either case, the market is testing a bear channel line. And the problem is 75% of breakouts of channel lines fail. It may be a greater than 25% chance we get this breakout because the channel is fairly broad. It's more like a trading range. But the problem for the bears here is when the market's in a bear channel, bears look to sell rallies and they take profits below bars and below swing lows. So up here, the bears are selling rallies. We come to a new low, they take profits. The market rallies for a couple of legs, they sell, goes to a new low, they take profits. So then we had a reversal, bars 4 and 5. Strong breakout and follow through, 4 and 5. So can you buy? Can you buy the close of 5 and go for a measured move? Well, it's kind of like the daily chart and the weekly chart. I was showing this on the weekly chart. If you buy here, stop below, your 1-to-1 is all the way up here. And you need to be 60% certain in order to go for 1-to-1 on a trade, at least 60%. And then you get bar 6, and then 7, and then 8. So this is not the follow through the bulls want to see. The bulls who are buying the close want to see another bar racing up and another bar racing up. And as soon as the momentum dries up, they might start wondering, wait a minute, we might be high in a trading range, and this could simply be a buy vacuum test of resistance. Where are we testing? Maybe we're testing the close of bar 56. You can see bar 6 actually tested that and sold off. And then bar 7. Bar 7 actually rallied before it sold off. And so some traders, after they get bar 6 and 7 starts to rally, the bulls who bought 5 will just exit at break even. And then that caused a lot of selling. Now bar 7 broke out a fair distance below 6. There's a lot of overlap, but this breakout was big enough to suspect sellers above and a second leg down. Now this is a high 1, but big bar, big risk, and you're at the top of a trading range. So bad context. Continuing sideways, and then bar 10, we had a second reversal. So the market rallied, reversed below 6, rallied again up to 10, and then reversed again below 10. So now we have a bear breakout and follow through on 12, probably going at least a little bit lower. But one problem I see, and this is common in trading ranges, when you get these, sell vacuum, buy vacuum, sell vacuum, you should always be careful. Always look for expanding triangles because these are common traps. The market looks very strong, but it's just testing a bull channel line. The market looks strong to the downside, testing a bear channel line. So bar 13, the problem is it might be 3 pushes down. And that increases the chances that the market will either get a deep pullback or reverse. Based on the open, here's bar 1. So far the market sold off, rallied, and sold off again. So we're getting a lot of two-sided trading. So the expectation at this point in the day is a trading range day. Sure, we could have a bear trend day, but when you also consider the context, here's the 15-minute chart. And let me just find today's open. So here's the context coming into the day. Do you really think this is going to convert straight into a bear trend? Probably not. Market has to go more sideways. So I think the best case scenario for the bears is a trading range. And if it is a trading range, we might go a little lower, but this could be low in the range. And then bad follow through 14, 15. So big down, big up, big down, big up. This is confusing. So the bears have the same problem the bulls had on 4 and 5. If you're selling the big bear breakout, stop up here, you sell the close, your target's all the way down here. And one thing we know about trading ranges, the first thing is most of the trading has been taking place up here. Just say maybe here, between these lines. What are the odds the market breaks out and goes all the way down here before it comes back up to the top of the range? Well, 80% of breakouts of trading ranges fail. And we know that gaps close in trading ranges. And right now we have a gap, a couple of open gaps from this bear breakout. But you can see bar 4, there's a gap between the high of bar 3, the close of 4, and then the close of 5. But then the market closed the gap. Now there's a gap from these prices, the low of 7, the low of 9, low of 10. But it's a trading range. There was even an open gap from the bar 2 low, but that closed quickly. Now the problem for the bears, along with the trader's equation being bad. And why is it bad? Because your risk is big and your probability is not 60%. If this continues selling off, then it's reasonable. The momentum stays, the probability stays high. But as soon as you get bad follow through, now all of a sudden it might be 50-50, or it might even be worse than 50-50 that we go here before here. And the reality is, since we've bounced, the market's closer to this price than this price. If you consider the context, it might be 3 pushes down and low in a trading range. The risk is real that we pull back all the way to up here. Now, bars 11 through 13, big enough and strong enough breakout that it should get a second leg down. But 14 and 15 are strong enough for their own second leg up. And then we got 4 bars sideways to down. Is that the second leg for the bears? Well, it's not clear, especially in real time. We didn't quite get to the close of 13 on bar 19, but you can see we came close and we got there in 2 legs. 1, pull back, 2, or 1, pull back, 2, pause, 3. And then we started reversing back up. So the problem here, though, with bars 20 and 21 is it may be the second leg for the bulls. 1, pull back, 2. There's probably sellers above bar 17. You can see the market went above 17 and then went outside down 24. What about a low 2 short for the bears? Bear breakout, low 1, low 2. It's okay to sell below 24, but you have to ask yourself what the premise is and what's your target, where's your stop, what's your expectation. 24 is an outside bar, and if you're selling below 24, you're entering on a stop order in the middle of a tight trading range, and that's not ideal. And then look at your entry bar. If you sold on a stop below the bar, it looks like you would not have been triggered. But the point is, it's an outside bar in the middle of a tight range, and we may continue to go sideways here. Couple legs down for the bears. We're testing an area where the bears got trapped. Let's say a bear sold above 19 and then got a 4-bar micro channel against them. The high of 19, that bad buy signal bar, becomes support. And we tested it and reversed back up. The market here is in a very tight trading range. Bears can argue, sell off 1, 2, 3, low 3 short here. Maybe you sell below 30 or 31, but this is a very tight trading range. And the more bars that get added to this bear flag, the less likely that it's a bear flag, and it may become a trading range with the breakout direction being 50-50. And if it is a trading range, keep in mind, we have a target up here, the bar 10 low. And the bears, they're expecting a second leg to at least go 1 tick below the low 13. But the market continued more sideways. We're going down again, but it's confusing. 2 legs up, 2 legs down. Even these legs are subdividing into 2 smaller legs. 1, pause, 2, 1, pull back, 2. Probably buyers in this area. Then 36, a little bit of a surprise bar. Now we have a gap from the high of bar 35 to the close of 36. 37 pulled back but did not overlap the high of 35, and that's a sign of strength from the bulls. The bulls bought the pullback, and we continued more sideways to up. So the bulls may be getting a second leg, 1, pullback, 2. But it's important to notice there's a gap between the high of 35 and the low of 37. That's a sign of strength. And then the market's continuing higher. And here, continuing sideways to up, we have another open gap. If you think about the line chart, you think about the closes of bars. The close of 43 did not overlap the close of 36 or the open of 37. So these bear bodies don't overlap, and we have a gap. So now we have two open gaps. This would be called a body gap or a negative gap. And this one, a more traditional gap where the tails do not overlap. So now the bulls have two open gaps. The bulls are getting higher highs, higher lows, and we have targets above in this trading range. So the risk is real that we go up here before we're down here. And remember, the longer this goes on, the less likely it's a bear flag. So back here, maybe the odds still favored a second leg down for the bears, 1, pullback, 2. But the more bars they got added, Al says once you get 20 bars in a pullback, it becomes more of a trading range. And the directional probability is 50-50. But another problem is that this may have just been a sell vacuum in a trading range. This was not clearly a bear trend. And when we look back, we'll say, yeah, the bears got their minimum second leg right here, and then they gave up. So we're drifting higher and higher. Then we got a buy vacuum. Bar 50, we're probably going at least a little bit higher. Probably going to test the bar 10 low, but then start to find some resistance. And you can see we tested that area, started to go more sideways. At this point, we're at the top of the trading range. Now, if we think about stop orders, bar 9, any trader who bought above bar 9 got trapped, and that creates resistance at the high and one tick above the high of bar 9. So any retest of this line, we're expecting resistance. 57, we touched it. 58, reversed down. Now this looks like a minor reversal. The bulls have enough momentum. We need a trend line break. Market's getting squeezed, but finally we get a bear breakout attempt, but it did not close below the moving average, and this all looks minor. It's a tight trading range. We don't have a clear trend line break, and the market's going mostly sideways. Bull bar, the top of a trading range, bad follow through. Bear bar, bottom of a trading range, bad follow through. 2 legs down, probably buyers below. Reversal up, 1, pullback 2, sellers above. And then we drifted a little higher, reversed back down. So very tight trading range. A lot of trading range price action today. For stop order trades today, maybe you buy above 4, taking a chance we'll come back up here. Maybe you buy above 5, but as soon as the momentum fades away, you're buying momentum here. You're buying high in a trading range. And if the momentum starts to disappear, your premise is no longer valid. If you're buying up here, you're not buying value. Remember, moving average, it's one measure of average. But the bulls up here are not buying value. The bulls down here are buying value. The market's cheap, we're low in a range. But up here, we're high in a range, we're above the moving average. So the bulls need momentum to keep them in the trade, and they don't get it, so they get out. So maybe second reversal below 10, you can sell below there. Signal bar isn't great, maybe you wait for bar 11, maybe you sell the close of 12. But then 13, that's going to attract profit taking. That's more of a buy the close bar than sell the close. I think it's aggressive to buy the close if you're flat to initiate a long, but I think if you're short, it makes sense to take at least partial profits. And all through here, for me, more of a limit order market. Stop order trades all through here. If you're trading with stop orders, you do what Brad calls fishing. Maybe you buy 28 or 29 looking for a bull breakout of bear flag, a surprise, a breakout that comes way up here. 30, you get disappointing follow through, you just get out. Bar 30 probably did not trigger the buy above 29 and just go straight down in 1 second. It probably stayed above the bar for, 20, 30 seconds at a minimum, and then started to drift down. And as soon as you get that drifting down, you know you're not getting what you need. You want to see trapped traders if you're buying on a stop high in a trading range. And then you can see if you bought the close of 29, even if you held through 30, you can see 31, the tail, the market rallied back to the close of 29 and then sold off. So all through here are fishing entries. You're buying on stop orders, taking a chance, and if you don't get the follow through you need, you get out. And through here, it's never really clear, especially with all the two-sided trading. When did it become always in long? It's really not clear. It's also tough to use always in on trading range days. Always in is more of a swing trading technique, and it's for trends. And when you're looking at a trading range, it's better to count legs and look to buy low and sell high. But really not the greatest day for stop order traders. And where do we go tomorrow? So this is the day only session, daily chart. You can see today we had an inside day, and we're at the top of a trading range. Here the market was in a tight trading range. We broke below it, we broke back into it. I suspect there are sellers not far above. We may have to test a little bit higher before we find sellers. Plus, this is a 4-bar micro channel. The first reversal down will probably fail. And it's an inside bar, and it's a bull reversal bar, so not a good stop order sell for the bears. If we do fall below today's low tomorrow, there will probably be buyers below. But if we go above the high, there are probably sellers because it's a trading range day. It was not a strong bull trend, even though it's a bull reversal day. When we crack open the bar, we know there was a lot of two-sided trading today. All right, thanks everybody for watching. I hope everyone has a good night.